Hey, this is Tom, and let's talk about SoFi. This is a brand new series called The Best Stocks to Buy, in which we take a stock, dissect it, analyze it, and see if it is indeed a best stock to buy or not. Now, SoFi, which is the stock we're covering today, is probably the most requested stock on my channel, with the exception of Palantir and Tesla, as you would expect. And in this video, we're going to dissect it. Now, on my little whiteboard behind me, as you can see here, I have all the parameters listed. And don't worry if you can't see it, I'm going to share it with you. But essentially, it's about management, it's about the balance sheet, the growth, the margins, the deal quality, the short interest, the potential. Don't worry if these are code words to you right now. By the end of this video, this is going to be super simple and you'll understand it completely. Now, this video has to start with where SoFi used to be back in 2021 when things were great. Now, this stock used to be $25 a pop. $25 a pop back in 2021. Now, ever since then, it has gone down to $8.50. And even though it had a phenomenal run over the last few weeks, last few months, it's currently down 10%, but it has a crazy, crazy run. If I pull up the chart over the last 3 months, it's done 60%. Over the past year, it's done 57%. Over the past month alone, it did 82%. The stock went through some crazy, crazy times, but in the grand scheme of things, the stock is still way, way lower than the $25 price tag it had in 2021. So our system today, we're going to evaluate the stock. We're going to make sure if it's any good. This stock has to go through the ringer in order for us to make that decision. Now, before we go forward, I'm going to be using my platform, Stock MVP, stock-mvp.com. It's listed below. We have a code LAST50. The reason it's called LAST50 is because we're about to discontinue all codes. We're required to do so because the app just went up on the App Store. We're no longer allowed to give out discount codes, coupon codes. So this is literally the last few days you have to cop it at 50% off. And if you get it now at 50% off, it's for a lifetime. So, make your decision. In any case, let's focus on SoFi, not my platform here. Now, what we're going to have to take a look at here is the quality of the CEO, the balance sheet, the growth rate, the short interest, the deal quality on the stock, and the overall potential of SoFi. Now, look, the stock is up 90% year to date. That's not as crazy as Palantir, definitely not as crazy as Nvidia, but still very, very high. And we're going to look at the numbers in just a second. But there's other things here in this stock that are a little bit alarming to me, and I'm going to list them. And it doesn't mean I'm bearish on the stock. Don't jump to conclusions. It just means that I am a balanced, objective analyzer. Whenever you want to evaluate a stock properly, whenever you want to be objective, you have to look at the good and the bad. You can't be absolutely ignorant to bad, red flags, etc. So the first red flag is, for me, obviously the parabolic spike. Same thing as Palantir. I've been vocal about Palantir as well. That's why the Palantir community seems to hate me a little bit right now. But, whenever something goes parabolic real quick, it's not super attractive for me, as far as an investment at that point in time. Now, there's a solution to that. I'll explain in a second. There's a system to bypass the FOMO and the hype. I'll explain that towards the end of the video. Now, the other thing I'm a little bit concerned about here, and I'm going to show it here on the screen, is just the crazy amount of short interest in the stock. Now, on Stock MVP, you can actually see the short interest right here, and you can see it on the screen. It's actually very, very alarming. It's at 13%, 12.6%. It is very, very high. Not excited to invest in a company with so much short interest. Even Palantir, that has a high short interest, has 8.5%. Double-digit short interest scares me. The other thing is, as I'm going to show you in a second, this company is not profitable yet. Although they're flirting with profitability, they're really close, but they're not there yet. They're way too leveraged for my taste, with $6.3 billion of debt, which is way more than the $2.5 billion they have in cash. They're bleeding like $300 million a year, which is kind of upsetting and not optimal for me. And I think, like Palantir, there's a lot of opportunistic dip buyers that have made a lot of profit over the past, few weeks, few months, and they're waiting for the opportunity to take their profits, which is going to put a lot of pressure on the share price in the short term. Now, these are my dislikes. And before we go through the numbers, I also have some likes. Number one, I think this stock has probably one of the best CEOs in existence. I think Anthony Noto is definitely the top 10 CEO in the United States. You can research the guy. he knows what he's doing. He completely turned around SoFi. What it used to be, what it is now, what is going to be. 3 completely different things, and he has most of the clout for that. Student loans are coming back, which is good, although I think that's already kind of priced in a little bit into the share price. Rates will come down. As inflation comes down, interest rates will have to come down, especially with what's going on with the banking industry. And that's a huge opportunity for SoFi because their business is refinancing. Interest rates go down. A lot of refinancing activity has to come through the pipeline. They have lots of potential. They have a new bank charter, which he just got by acquiring a bank. And, this company is not trading at super expensive levels at $8.50. It's 4 times price to sales, much better than what it used to be at $25 a pop. It has 22 billion in assets versus 17 billion in liabilities, which is, decent ratio. And to be honest, even though it's very leveraged, it has enough cash to basically operate for 8 to 10 years without diluting shareholders, which is really, really helpful for me because I know they have stability. There's no dilution or debt coming. They're burning 300 a year. They're sitting on 2.5 billion. And even if they just keep burning cash, they have 8 years. So that's not bad at all. Now, looking at this thing right here, I want to scroll down. So I want to show you. These are our stock MVP quick cards. You can edit your own. These are the ones I want to show you here. So what I want to show here is, first of all, the revenue. At 1.7 billion, it really reminds me a lot of Palantir. Palantir is at 2 billion. They're at 1.7 billion. Very similar structure. Growth is actually way better than Palantir at 53%. Incredible growth here. But as you can see, operating expenses are almost broke even. 1.6 billion, which leaves us operating income of 56 million. So the company is technically operationally profitable, which is a sign they're about to be profitable for tax purposes and for cash flow purposes. So that's good. But they're just on that borderline. Essentially, this is a break-even company, which is in itself quite impressive in this economy. What I do want to show you is this right here, 2.5 billion in cash and cash equivalents, but 6.3 billion in debt. Very leveraged. Not a huge fan of that. 22 billion in assets. As you can see right here, we talked about this versus 17 billion liabilities. Now, the valuation here, look, we don't have price to earnings, naturally, because it's not a profitable company. But, 1.4 price to book, 4.7 price to sales. I mean, it's not an expensive company. I think I said earlier PE. If I did, I'm sorry. I meant price to sales, obviously. It doesn't have a PE. But, 4 to 5 price to sales at 1.4 price to book, at a company that's borderline operationally profitable, generating almost 1.8 billion in revenue and growing at 50% a year. That's actually quite impressive. I'm not going to lie. I think it's a cool number. Now, I do want to show you something else here, and I'm going to take this out the screen so we can use a different window. Now, this is another feature we have here in Stock MVP, and this is a way for us to take a look at what analysts are saying about the stock. As you can see in the corner here, we have the average analyst price target. The average analyst price target right now on SoFi is $10, which is significantly higher than the current $8.50 share price. But you have low targets of all the way down to $2.50. And I'll show you why those also make sense. And I'm not being hateful on the stock. I'm just saying it's possible. It's possible that it goes to 10 or 22, but it's also possible to see at 2.5. I'll show you why. A lot of the assumptions about this company is going to drive the valuations. It's not such a simple thing. Then you can just, kind of assume and run a quick DCF. It's not that simple. This stock requires a lot of nuance. Now, talking about nuance right here, this is what I was talking to you about. This is our SCF tool. Here we calculate valuations in 3 different cases. On Stock MVP, basically the conservative, the middle ground, and the optimistic. Now, I'm not going to bore you with the assumptions. They're on the screen. You can pause the video and check our assumptions here, and you can plug in your own if you're a Stock MVP user. But for us, this is where we at. So the conservative, the bear case for the stock is a $3 stock, very similar to the analyst, by the way. The 5-year kind of middle ground, which seems to be the most, plausible or the most probable scenario, is $15 a share, which is quite higher than the $8.50. And the optimistic Cathie Wood scenario, that's the $27 per share. So that's the range in which it's going to operate as a growth company. A lot of speculation, a lot of risk, high risk, high reward. $3, $28, $27. It's a big margin, but at the end of the day, you have to make a decision if this stock is even good enough. Because I mean, you can't just go based on hype and just say, oh, this stock can go to $27. I'm just going to buy it. No, you have to actually analyze it and see if you like it. So in order to analyze it, you have to learn how to run a DCF, a discounted cash flow valuation model. You can do it yourself with a simple Excel spreadsheet. It's not that complicated. We've built this model here for you, which makes it for you. It takes data from the financials of the company and it creates its own DCF. Right now, this is what we have for SoFi based on our DCF. Of course, you can change the data in yours. Right now, our DCF gives us a 10.12 DCF valuation, which is a 17% upside on the stock. But of course, for some people may find this annoying. If you're a huge SoFi bull, don't forget my DCF for Palantir is about $8 a share. So, and I'm the one making $500 thumbnails on Palantir. The DCF isn't everything. I'm investing in Palantir, expecting a $500 per share price, even though I see a DCF of 8. So it's an objective way to kind of gauge what's the current valuation of the company given its current numbers without taking into account any exponential growth in the future, which I think SoFi has a lot of potential to do it. Much like Palantir, SoFi has that potential to create exponential growth. And in that case, this DCF is meaningless. But as it stands right now, it's a 17% upside, but it's definitely up there as far as potential, massive potential. As far as the bank charter, the all-in-one app they're building, it's absolutely insane what they can get to. One last thing here on Stock MVP that I like to look at is what the institutional investors are doing with the stock. That's the Achilles heel of this stock. It's very similar to Palantir in this aspect. Palantir also suffers from the same problem. That's why I think the Palantir investors are feeling the pain of the SoFi investors. 37% institutional shareholding. Palantir has a similar percentage. It's not optimal. We want to see 60% at least institutional shareholding because it adds a lot of stability to a stock. And at 37 is just too low. There's too much retail action. And unless you're Tesla, retail investors tend to be a little bit more volatile. And then you see these crazy swings in the share price. So not exciting to see that craziness as far as, all this institutional investors not buying into the company. As you would expect, when you have a company that's not profitable, speculative, in times like these, institutional shareholders, they tend to take their time on this, and that's okay. Now, in my view here, this stock has a lot of potential. It checks a lot of the boxes. The CEO is great. The balance sheet is okay. The short interest, at 13%, it's a tad high for me. And the main problem here is that the stock, again, it doesn't get that institutional influx. That's why it's being held back, similarly to Palantir. And unfortunately, when you have such a high retail participation, much like Palantir, the moment the dip buyers decide to jump off the ship because they think it's coming down, it's going to send the stock price down and it's not going to be pretty. But how do I invest in a company like this if I have faith in it, right? Same answer as Palantir. If I like SoFi and I think this is a great company, which a lot of you may think, and I can't argue with you. I mean, there's definitely a case to be made of why this company is probably one of the highest potential companies in the market right now, as far as fintech for sure. So again, this is what I do. What I do with SoFi, if I like the stock, is something very simple. I decide a dollar amount I'm going to invest every single month into the stock, and I keep buying every single month, no matter what the price does, with one exception, which is kind of the pro adjustment to this rule. If I see the price goes below 10% off of the 52-week high I have on the stock, then at that point, I start doubling down. I double my amount, and I stay doubled all the way until the stock price climbs back up, and it gets to that 10% threshold again, and it goes within that 10% range from the 52-week high. At that point, I go back to my original amount, and I keep putting it every month. The idea here is to slowly build your position over time, slowly, dollar cost averaging to a good stock. When it goes down, you benefit. When it goes up, you benefit at the end of the day because you create an average. Now, this is just the tip of the iceberg. If you want to learn more about the system of how to invest in good companies over the long haul, how to be a smart investor, how not to get into hype and FOMO and get rug pulled, how to beat the system, because don't forget, our students are the ones who are buying the dip of Palantir and now are seeing the 130% spike that we've seen. That's how you do it. Now, the way to do it is to join my Patreon right now on the screen on the right-hand corner at the top, you can see it, patreon.com/Tom Nash. On my 4,300 member community, which you can sign up, I teach proper investing, how to be a long-term investor, how to do it the right way. I teach you a system, I teach you discipline, I teach you a process. None of this get-rich-quick stuff, none of this bullshit on, swing trade, day trade, buy a Lambo. This is a slow process. This is a marathon. Now, I charge $5 per month, the price of a cup of coffee, not even anymore with inflation. And I give you a 30-day guaranteed money back for whatever reason. If you don't like my Patreon, take your money back within a month. No problem at all. Now, the reason I do this is because I want to democratize the information. I don't want to charge $30 and make a shit ton of money. I want to charge a little amount so I can undercharge and over-deliver and make a lot of people happy. That's my goal. My goal isn't to be the next billionaire. Simple as that. If you're cynical, if you think that this is me just, blowing smoke up your bum, it's fine. This is not for everyone. But if you are digging what I'm saying here and you're connecting with me, check out my Patreon and try it out for a week, for two, see if you like it. I think you owe it to yourself to learn the system the right way. Now, here's the crazy part. Everything I just showed you here, you can do for yourself, whether it's for SoFi or any other stock. Stock-mvp.com. This is a platform I've created because I couldn't find anything like this. I couldn't find a way to do a DCF model in a minute. I couldn't find anything to show me these quick cards where I can see all the information about the company in a minute. I've built this with my partner, Pete, my business partner, Pete. You can try it out for a week, risk-free. We give refunds again here as well. Same policy. Now, if you want to try it out, that's fine. But if you want to get it at 50% off for a lifetime, these are the last few days before we cancel that coupon code. We have to. Terms of service of Apple, of the App Store, requires to do so. So go get it right now before we cancel it. I'm not just saying this. Trust me, this is literally your last chance. Last 50. Thank you so much. I'll see you in the next video.